Well, Rachelle, let's dive right into what we're watching today. You highlighted those two, and we're going to start with the Fed. Of course, that decision coming down at 2 p.m. Eastern today. The expectation is that the Fed will, in fact, hike rates by about 50 basis points. But a number of things that we're watching today in the lead up to that decision. You just highlighted the yield curve there. And Rachelle, we've been talking so much about sort of the inflation data, economic data that's been coming down. But if you've been watching the yield curve really closely, it does point to some of those recession signals that we have come to accept. Where last week we were talking about the widest gulf here between the short and long term yields that we're seeing. Obviously, the yield curve now inverted. For the last 50 years, it's been a sign of a recession. Certainly investors are going to be watching that, although we have seen it narrow just a bit. And I wonder if we can just pull up that chart yet again to show you what we are seeing, the difference between the 2-year, the 10-year, and the 30-year yield, something very closely to watch. Of course, expectation is already kind of baked in terms of where the Fed's likely to move. But to your point, it really will be about the language from the Fed. And I know, Rachelle, you're also watching the impact on the housing sector really closely here because those mortgage rates, we have seen it go up.
It's true. I mean, I think investors are really looking for any sort of data points to really get a gauge on what we can expect going into 2023. And as we look at what we've achieved, what the Fed has achieved over the last 6 rate hikes, as we take a look here, because obviously you have the housing market, but you also have the stubborn labor market, which doesn't seem to be shifting. We saw that with March's first start of that 25 basis point hike, followed by a 50 basis point hike in May, followed by 4 subsequent 75 jumbo basis point hikes. And as we look at that stickier part of the inflation story, the labor market, it started around 4% at the beginning of the year. It's now at around 3.7%, not much movement there. But then when you look at what we've seen with the 30-year fixed mortgage, that started at the beginning of the year at about 4% as well. And we see that's currently at about 3.7% there for the labor market. But interest rates at now about 6, almost 7% now. They've started to creep down a little bit in November, but started to tick down a little bit further also in December. But that's still double where we were at the start of the year when it was 3%. And we know that mortgage rates is what people are always tending to look for when they see these Fed announcements coming out.